Hello, ladies and gentlemen. My name is Greg Mikulowski from ForexLive.com. I'm going to talk about the dollar versus yen. Actually, I'm going to talk about trading and psychology of trading. And it all came from a comment from Andy this morning to that post. Andy said this looks like a very good bullish setup for the dollar versus yen. The Fed and the Bank of Japan come next week, which should give it another kick to this pair. He's talking fundamentally. We don't know whether or not this is going to happen or not, but we do know something about the technical, so I'll get to that in a second. Funnily enough, no one is here talking about how they're buying this dip. This type of thread, that is Forex Live, was overflowing with buy the dip comments when the dollar yen was setting up for a break lower around the 111 level. It's like the retail crowd is contrarian, but everyone is contrary in the same direction. And the fact is, that's true. That's true. But why is it? Why does that happen? Why do the traders have the courage of 1,000 matadors to talk about buying against the 111 area, but then when the price goes lower and much lower, they aren't talking about buying here or buying at lower levels through here, or even buying at today's level at 109.50 or thereabouts? And the reason is because they got burnt. Okay, the traders gathered, they all talked at this level right here, and when the market went lower, they bought even more, they bought even more, they bought even more. They were waiting for that rebound back to the upside, for the market to get above the 111, and for everything to be happy again. It never did. They probably sold down here and they lost a lot of money, and so they got burned, okay, and they lost a lot of money, and that hurts, and that hurts. And what happens when you hurt? You coil up in a ball. You ignore it. You don't have an opinion. And when we have 9 trading days or 10 trading days that we've had here, where the market kind of goes nowhere, we move to the upside, or we move to the downside, we move to the upside, we move to the downside, move to the upside, down, up, down, up, down, up. And we stay within this box. What is it saying? Well, it's saying that the market is non-trending. It's saying that the market doesn't know which way it wants to go all of a sudden. Even though the prices are lower and they thought the price was going higher at 111, they don't necessarily think that right now. And it says that they don't. It also says they don't care. Okay, why don't they care? Because they got burned. The retail traders got burned. But we can't let our burns get in the way of our next trade. And so, Andy and traders out there, we have to stay awake to the opportunities, to the low risk opportunities that allow you to make a little bit more money back. And we have to understand that we don't have to risk a lot, like from 111 all the way down to 107.50 or 60 or wherever it's bottomed out. We only have to risk a little. And so my one thing that you can do is, or that you should do, is define risk, by using tools, and look at the price action, because the price action doesn't lie. And when I look at today's low, and I look at where it bottomed here, I see the price bottom against the 200-hour moving average. I see the price bottoming against the low that we saw in yesterday's trade, swing low, which forced the move to the upside. I see the price bottoming against the 50% retracement of this move from this high to this low. All those things gathered in this area right here. And we found a buyer there, or buyers there. Buyers there who are willing to risk, get ready for this, they're willing to risk this amount on that trade. The difference between here and here. And as you can see, it doesn't take much to make 1 times that, or 2 times that, or 3 times that, or 4 times that, or 5 times that, if you trade at the right level. And we don't know that the market was going to go higher there, but and the people that bought there didn't know that. But what they did know is that their risk could be defined and the risk could be limited. And that's the most important thing in trading, folks. It's not your opinion. It's not that you can talk the loudest on a comment board. It's that you can define your risk and limit your risk, and that's going to make you money. So the horses sort of left the barn. We moved above the 100-hour moving average. We moved above this top side trend line. We moved above the high price from yesterday. Now we're trading at the 109.53 level. You have the opportunity to buy lower and have a nice little trade already. And if the market should go above this level, we should move a lot higher and all. But my point is, be awake, folks. Be awake. Don't sulk. Don't think about your old trade. Don't think that the market's never going to go anywhere. It's not going to break out. It's not going to do whatever. It will. There'll be someone who sits there and buys the market at a nice level and makes a decent profit with little risk. If you like this video, make sure you go to our YouTube channel and you click the thumbs up. If you didn't like it, just click the thumbs down. And if you want to subscribe to our YouTube channel, click on the subscribe button at that YouTube channel as well. It is through your comments and through your thumbs up and thumbs down that we get the feedback that we need for allow us to do these videos for you. My name is Greg Michalowski. Good fortune through trading. Bye-bye now.